Good morning and welcome to another Morning Markets here at True Potential. The labour market is too tight and inflation much too high. Those were the words of Chairman Powell yesterday evening as the US Federal Reserve delivered another 75 basis point hike in official policy rates. This takes policy rates in the US to between 2.25% and 2.5%. And this is the range that the Federal Reserve themselves would call neutral. It is neither slowing the economy nor allowing it to accelerate. Now, we've seen a rapid increase in interest rates in the US over the last 2 months, 150 basis points, which is the largest increases in over 25 years. But the committee have now indicated that they're prepared to start slowing these increases towards the end of the year, and that over the next 3 meetings, we may see another 75 to 100 basis points increase in interest rates, which would take US policy rates to roughly 3.5%. Now, why has Chairman Powell decided to moderate his language on future interest rate hikes? Well, it's largely because the committee are aware that they have accelerated policy tightening and they are seeing some indications of the economy beginning to slow. It's not coming through in the official measures such as employment levels or in inflation, but on the run measures of activity are showing some slowing in manufacturing and services. And the committee are sympathetic that this may start to reflect in the harder data as we go into 2023. So if we look back to the forecasts that the committee delivered last month, they expect to see inflation peaking this year and begin to decelerate rapidly next year and into the target range by 2024. They also expect to see some rise in unemployment through next year and possibly into 2024, but it will be very modest in the range of 0.5 percentage points. And the committee believe that is enough to take the froth off inflation and to allow inflation to go back towards target over the next 18 months or so. And this justifies some of this sympathetic language towards future interest rate hikes from Chairman Powell. But what is the challenge the US Federal Reserve face as we head into the rest of the year? Well, it's largely to do with market pricing versus the Fed's expectations. Markets expect the US Federal Reserve to begin cutting rates early next year, whereas the Federal Reserve still think they may have to deliver 1 or 2 more interest rate increases of possibly 25 to 50 basis points through next year. So this perhaps explains why equity markets took yesterday's news so well. They believe that we are now past the peak in policy tightening from the US, that the Federal Reserve will be more sympathetic towards slowing economic data at the end of the year, and possibly may cause a hard stop in interest rate increases in early 2023. This would support equity markets, particularly in the US, given that we'd have the majority of policy tightening behind us. However, the Fed will face the communication challenge as we head towards Christmas in trying to indicate where they expect to go into 2023. And as you can see on screen, big increases in US equities overnight as markets reacted well to this dovish language. So the US Federal Reserve take a break now as they head into their summer holidays, but we'll wait to the end of August before we get some indication on what the next interest rate hike there might look like. Now, what about today? Well, later on this afternoon, we get the GDP print for Q2. Now, market consensus is for a small, modest increase in growth in the United States through the second quarter, which would make the contraction in Q1 look like an anomaly, largely to do with measurement effects, which have been somewhat typical in Q1 prints from the US in previous years. So colleagues tomorrow will update you on the details on that. So please do tune in to tomorrow's Morning Markets and also to our podcast, Do More With Your Money, tomorrow. Thank you.
If you're interested in taking your investing to the next level or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.